volume profile is the closest thing to a cheat code in trading. But here's the problem. 99% of traders have no idea how to use it properly. They'll add it on their chart, stare at the random bars on the side, then try something overly complicated and fail. And that's a shame. Because once you actually understand how to read it, the volume profile shows you exactly where the market wants to move next. Not where you think it should react, not what your indicators tell you, but where real money exchanged hands, the actual backbone of the market. And once that clicks, you start seeing the market in a completely different light. You stop reacting to every new candle and wick. You stop drawing random levels, hoping they'll hold. You finally start trading with liquidity instead of against it. Most people spend years chasing secret strategies and new indicators and end up nowhere. But the difference is, this isn't about adding more tools. It's not about getting easy signals. It's about finally understanding how the market actually moves. So in this video, I'll show you how to turn volume profile into your unfair advantage. How to use it to spot those level-to-level moves that literally print money when you get them right. So here's what the volume profile actually shows you. It tells you how much volume was traded at each price level. Instead of just looking at candlesticks and price movement of a period of time, you're seeing exactly where traders and institutions exchanged money. It's like suddenly seeing where all the activity really happened. This adds a completely new dimension to the market, and one that you can use to trade with devastating precision. Now, adding volume profile on our chart is simple. There are a couple of different variations of the volume profile, but the main one we want to use is the visible range volume profile, or VRVP. And as the name suggests, this is going to account for all the volume of whatever is currently visible on your chart. So we go into the Indicators tab and type in VRVP, then select this one. Once we have that on our chart, we go into the settings and change the row size from 24 to 200. And then you can change the color to gray if you want. Now it should look something like this. The reason we use the visible range volume profile is we want to be able to take in all the relevant information that we're currently seeing on our chart. That way we don't have unnecessary volume from the past and only have what we need. Now, it's very easy to make the volume profile more complicated than it needs to be. You can write a whole book just on the different day types, patterns, setups, variations, bar size, and much more. But if you know anything about this channel, you know that we like making things as simple as they can possibly be. We cut out all the unnecessary nonsense. Then when it comes to the volume profile, although it may seem complicated at first glance, it's actually incredibly simple. To use it properly, you only need to focus on two areas: high volume nodes and low volume nodes. Let's start with high volume nodes. Now, a high volume node, also known as a HVN, are the volume spikes that we see on our chart. These are areas with heavy volume and activity. It's where the price slowed down and built structure because there was a balance of buyers and sellers. And a low volume node, also known as an LVN, is the opposite. These are areas on the profile with very little volume and trading activity, and the price usually moves quickly through those areas because nobody wants to do business there. There isn't much really slowing the price down. So think about it as if you're walking through a forest. If you're walking through a dense area with a lot of trees and vegetation, it'll naturally slow you down, and you'll need more effort to keep pushing through. But if you're moving through a thin area without many trees or vegetation, it's much easier and quicker to move through, with much less effort. That's why you'll see the price moving quickly through lower volume areas and slow down in high volume areas. Buyers and sellers are balanced when in high volume areas, and there's an imbalance when one side is dominating and moving quickly through a low volume area. And once you start recognizing that pattern, where the market moves from balance to imbalance and then back to balance, you'll understand how the market actually moves. It doesn't move randomly. It moves from one HVN to the next with those LVN as air pockets in between. That's how institutional money finds liquidity and flows in and out of the market. And it's exactly how you should be reading structure too. So here's the thing. The market doesn't move for fun. It doesn't move because some indicator gave you a signal or because you drew some pattern on it and expected it to work. It moves because of liquidity. And liquidity is the fuel that drives every single candle you see. Every push, every rejection, every random wick. All of it comes down to one thing: the market looking for fuel. Now that fuel builds up in very specific areas, the HVN. That's where the market loads the tank. Buyers and sellers meet, orders get filled, and volume stacks up until price has enough energy to make its next move. Once that balance is full, once everyone who wanted to buy or sell at that price has done their business, the market has no reason to stay there anymore. It needs to find new liquidity, and the only place it can get that is at the next HVN. The market has to move this way, from balance to imbalance, from one HVN to the next. So instead of thinking of price like some unpredictable roller coaster, start thinking of it like a delivery route. It stops at one location, picks up or drops off liquidity, then moves straight to the next destination. That's why when you start reading volume profile correctly, you can actually anticipate where price needs to go, not just where you hope it goes. So now, all you need to do is decide which HVN it moves to next. That's literally it. You don't need to overanalyze price action, daily levels, context, news, events, or anything else. And the way you do that is with three simple filters: structure, trend, and momentum. First, structure. Ask yourself, which side has built stronger structure? Are buyers defending levels and forming higher lows, or are sellers holding resistance and printing lower highs? Structure tells you who's currently in control. Second is trend. Where's the overall flow pushing? Zoom out to your higher time frames, the 30-minute and the 1 hour. If structure says one thing but trend says another, sit on your hands. When they agree, the path becomes obvious, because the market will reward alignment, not contradicting signals. And finally, check momentum. This is where you confirm who's pressing the advantage right now. We just want to see clean directional movement. When all three align, that's your green light. You're simply following the path of least resistance, the exact route the market has to take to find its next pocket of liquidity. So let's see what that actually looks like on the chart. In this case, price tried to break higher multiple times, but every single attempt got rejected. You can see it clearly. Each push up into that resistance zone gets slapped back down. That's your first clue. It's showing you that sellers are defending that level hard, and buyers just don't have the strength to break through. As that keeps happening, something important starts to form: structure. We're seeing lower highs and lower lows, one after another. That's the market telling you that momentum is shifting. At this point, the downside is completely exposed. There's no major support sitting underneath current price and no significant structure until the next HVN below. And when you understand how the market moves, that alone tells you everything you need to know. The market can't stay here forever. It needs liquidity. And when it can't find enough of it up here, it's going to go looking for it down there, at the next HVN where orders are waiting to be filled. So now the path becomes obvious. We've got structure pointing down, lower highs, lower lows, clear resistance overhead. We've got momentum pressing in that same direction, with candles cutting through the low volume areas cleanly and decisively. The higher time frame bias is already bearish. Everything lines up. So this is where we execute. We go short. Our target is the next HVN below because that's where the market is most likely to slow down and refuel. Our stop goes just above the next upper HVN. That's the line in the sand. If price pushes back above it, then our idea is wrong. Simple as that. Because here's the thing. You don't need to be right about every trade. You just need to play the structure correctly. As long as you respect your stop and trade your plan, the probabilities will always play out over time. And that's one clean level-to-level move complete. Just structure, liquidity, and a clear understanding of where the market had to go next. Once you start looking at price action through this lens, you can't unsee it. You'll start noticing the same rhythm everywhere. The market loads up at one HVN, runs through the thin zones, and refuels at the next, over and over again. That's what makes this tool so powerful. It's not an opinion and it's not guessing. It's simply understanding how the market operates. You realize that there is no better way of knowing where price is headed next. You stop asking, what's going to happen next? And start asking, where does the market need to go next? That's the difference between a trader who's reactive and one who's consistently profitable. When you trade this way, you stop trying to control the market and start flowing with it. Your emotions quiet down. Your decisions slow down. You're no longer attached to every tick. Now, I built an entire trading system around this level-to-level concept, and that's known as the LCE model, which makes this entire process even more simple and systematic. I'll link some videos here where I explain the entire process that you can watch right now. And here's the thing, we think we need more trades and more analysis, but what we really need are fewer decisions, fewer impulses, fewer distractions, Just doing the same thing, the same way every single time. And that's the exact shift I help traders make inside my mentorship, building a simple mechanical framework around structure, liquidity, and execution. If you're ready to get consistent and finally start trading systematically, the link's below. And if this video helped, be sure to leave a like and subscribe because I drop videos like this every week. See you in the next one.